Hi, this is Skyler with Regan. Today we'll give a brief update on the curve and look at the Treasury floating rate market. If we look at the Treasury curve year to date, or month to date, sorry, we're starting off with very similar front end of the curve, but let's get to the raw data here. And we've dropped around 30 basis points between 2 and 3 year, 10 basis points on the long end. So go back to this, and this is where we started, and this is where we are today. Pretty deep rally in the belly of the curve. So let's look at SOFR. SOFR is what determines most of the floating rate universe out there worldwide. It used to be LIBOR. And the SOFR curve starts here at about 540 and dramatically drops here in September and then again in December, reflecting the market perceiving the Fed cutting rates in both of those months. If we look out 1 year to July 15th of next year, we go from 540 to 380. It's about 160 basis point rate cut. It's about 6 Fed cuts embedded in the curve over the next year. And if we go out 2 years to July of 2026, we get down to 350. It's about 1 more cut. So about 7 total Fed cuts between now and 2 years from now, 6 of them happening in the next 12 months. If you look at the Fed calendar, if we ignore the Fed potentially cutting here in July and again in the election month of November, that implies the Fed cutting in every single other meeting between now and a year from now. The Fed meets 8 times a year. If we say that they're not going to cut in 2 of them and we have 6 cuts embedded, they're going to cut in every single meeting. That's what the curve currently implies. Okay, so if you want to take the over on that, if you think the Fed's going to cut more than 6 times, you might want to go buy fixed rate instruments. Okay, 3, 5, 10-year bonds, which will outperform if the curve steepens even further. Okay, the back end of the curve falls further. If you think the Fed's going to cut less than 6 times, you might want to own floating rate paper. Okay, because floating rate paper is going to sit right here and it's going to adjust off of the front end of the curve. And we've talked about this, but with an inverted curve like this, some normal traditional fixed income math doesn't work. You're not rolling down the curve, you're rolling up the curve. And fixed rate instruments will actually underperform as it rolls up the short end of the curve here. So what should you do? I'm looking at Bloomberg. This is PX1. This is a screen that basically has all of your short-term instruments here, has some of your longer-term treasury instruments here, but I'm going to go to FRN, floating rate notes, and talk about Treasury floating rate paper. There are currently 8 issuances. Okay, the Treasury, this is a relatively new occurrence where the Treasury is issuing floating rate paper. Okay, and I built this spreadsheet over here where I'm just bringing in, if you wanted to put in yield, coupon, price, etc., you could do that. But for these purposes, I just really wanted to highlight the amount outstanding of each of these issuances. So you have this bond here that matures in about 16 days from now. It's about $70 billion, okay? You add all these up, adds up to about 600 billion, which is almost nothing relative to total treasuries outstanding. Total treasuries outstanding is almost 25 trillion. This number here is all public debt outstanding. That includes local debt, state and municipal debt, about 35 trillion. So as a percentage of total treasuries outstanding, only about 2.4% is floating rate. Okay, but in this curve, it might pay off to sit on the front end of the curve and earn what's currently about 545 yield. And I like to compare these 2 instruments here. This is SGov. This is a money market, not a money market fund, but it's an ETF that invests in very short duration treasury bills, charges about 9 basis points. It's about a $24 billion fund. And then let's look at USFR, stands for US floating rate. This is a wisdom tree fund, charges 15 basis points. It's about 18 billion. And this only owns those floaters. Let's look at their holdings. Okay. You have 4 holdings right here. Each are about 25%. Let's look at the holdings of SGov. All very short duration. Here's your maturities. September, August, and July, very short duration treasury bills versus floaters. How have these two performed versus each other? Okay. So this treasury floating rate instrument, USFR, has only been around since 2020. I don't have it on here, but it's been around since about 2020 because it only goes back. Here it is right here, May of 2020. But you could see here, even despite a little bit higher fees, about 6 basis points higher in fees, you're getting about 50 basis points, 60 basis points of outperformance. Okay. How about year to date? Year to date hasn't been as good for floating rate instruments as fixed rate, because fixed rates are actually positive on the year. But still, the floating rate instrument here has outperformed by 20 basis points. How about over the last 3 months? By about 1 basis point. So just something to think about as we look at this curve, which is still inverted. It's been inverted for over 2 years now. The math tells you to stay at the front end of the curve until this flattens out. And I don't know if it's going to come from a bull steepener, the front end coming down, or a bear steepener, the back end selling off. But until the curve gets flat, the curve favors owning more floating rate paper than fixed rate paper. Thank you.